Hey everybody, welcome to Trading Capital's daily analysis video. I'm your head market analyst here, Curtis Scouten, jumping into the charts on July 11th, starting with the S&P 500. Overall, it has been a sell-off day for the markets as we head into this new week. And what could be transpiring, and one of the reasons we're seeing a sell-off, is not only have we had a pretty substantial rally off of the lows, but we have run into major resistance. And I think one of the reasons why we're selling off, there's a couple reasons actually. Well, one being the fact that the US dollar is continuing to surge. It made a new high today, and we'll have to monitor it when we flip to the chart. So the fact that the US dollar has completely started to make another run up is certainly putting a lot of pressure on the overall markets and indices. And second, we have tons and tons of economic data coming out this week. Really, the important things start on Wednesday. We have the CPI numbers. We have Bank of Canada interest rates decision. Then on Thursday, we have PPI numbers. Wednesday, Thursday, we also have tons of energy data regarding oil, natural gas. And then also Friday, I believe there's job loss claims and a whole host of other things. So lots of economic data, which could be unsettling for the markets. And when people generally don't know the direction of where that economic data could turn out, people rather just sell, wait on the sidelines, wait for that data to come, and then they can rebuy into the markets. So we're certainly seeing some fear, but overall it's not a tremendous sell-off day. And the fact that we're seeing this sell-off on extremely light volume, certainly, when you have vicious selling with light volume, the selling pressure can be pretty fierce and immense, and it's not really that fierce and immense. There's certain names like Twitter, 2U, Teladoc that have been hit a lot more. But that being said, the overall S&P is only down right now about just over 1%. So if you notice here, we had an immediate gap down. This was your intraday high. And essentially, you tried making a rally to take out this high. You failed to close above it, so that sent you right back down to test pretty much the lows. Now you're still holding these intraday bottoming tail right over here. So we'll just have to continue to see what type of consolidation we get. Right now we are kind of more in a bearish consolidation. There's actually a head and shoulders pattern that is triggered and is playing out. So you have a left shoulder here, a head, a right shoulder. Your neckline is over here, which was broken with that gap down. And this pattern takes you roughly down to the, well, I'll just draw it on the chart here, around 380, about there. So you can see we still have a little more downside. There is a technical gap fill around the 38.44 level here that we just missed. So since we're consolidating over that, I do feel that we're going to have another leg down potentially tomorrow. I don't think we're going to take out the lows today. Anything can happen with 20 minutes left, but I do think that we potentially consolidate and have a leg lower tomorrow. So overall, there is a gap now made to the upside. There is still a gap to the downside here. And then if you flip down, there is still this lower gap over here on the chart. But if we flip to the daily chart on the S&P 500, overall, that's the hourly. Let's flip to the daily chart. Overall, you can see why we've run into resistance. So again, we had that initial move up, pullback, back to your retrace of your breakout zone, and you've had another move up. Now you really want to start holding this green range bar, or at least this candle over here, before you can consider this pattern technically damaged. You can see that we've run into resistance here at this downsloping parallel channel. So clearly that the fact that this has been resistance once, resistance twice, the fact that you're hammering on that level, if the markets do catch some sort of a little bid, you should see a move up through that resistance to this gap fill. Since you've hammered on this resistance now once, twice, the third time technically states that you have a higher degree of probability of breaking through that resistance level. So let's just continue to monitor the S&P 500. Overall, I think it's been a controlled day. It hasn't been really something to fear. I do think that inevitable turn in the markets comes, but I do think we should still head up and potentially fill this gap. And if we flip to the NASDAQ, the NDX, it's a very similar chart. You did fill this technical gap over here just today, so that's a pretty positive sign. You only have really one technical gap to the downside, whereas opposed you have 1, 2, 3 technical gaps, and a lot more appear to the upside. So I'm still in the camp that you do see a favorable move up. One of the reasons I think we're going to see a move up in the indices sooner is if you simply look at the DXY. This has been a power surge. I mean, if we flip to the weekly chart of the DSI or the DXY, you can see this has practically gone just parabolic. The fact that you started at the beginning of June over here, beginning of June, you just had this meteoric parabolic rise. You are into tons of resistance. Well, you're getting into some long-term resistance. I was actually adjusting this channel. I had it a little bit lower to match these pivot highs over here, which you're running into right now as we speak. But I think the better scenario is to connect this pivot with this pivot up here, and you can see that that will take you roughly to the 109, 110 level before you hit major long-term resistance. And this parallel channel has kept you in check for basically since 2005. You've had a range here at the high, a support range at the low, and so on and so forth. So if we potentially get, 1 or 2 more days of upside in the US dollar as people flee to safety for cash, I do think as soon as we hit this level, that could be the signal where the indices turn and start to make potentially a little bit of a run up. Obviously, anything can change and transpire, but I do think that since the US dollar is extremely overbought, it is heading into long-term resistance. Once we hit that resistance, it does favor a pullback, at least down to this original double top zone around the 103, which should breathe some fire into the indices. Obviously, with a surging dollar, if you look at gold, gold has had yet again another down day. I do think gold has to go down to the low range of this channel, which should coincide with the US dollar, the DXY, hitting the top of its range. So it's merely an inverse correlation range. The fact that the US dollar has gone extremely parabolic and gold in US dollar terms is still holding relatively well is pretty impressive. So I do think there will be another buy opportunity for gold once we hit the low range of this channel. Expect me to issue another GLD alert. Obviously, if we look at silver, it's pretty much following gold. It's still at support, holding that lower end of the range, but I do think commodities should see additional pressure as the economy starts to slow. Let's take a look at the oil chart, WTI. Really, there's nothing new to report down here. I mean, we did have a little bit of a sell-off today, and oil has rallied back. You're still hitting that resistance, this parallel channel. If you get through that, nothing's really changed on that end. You'll hit the top of this resistance line around the 110, 111 mark, which will be a tremendous opportunity, another major area of resistance. But overall, if you look at this wide range red bar, I don't think we're going to get through that during this cycle. I think we've made a cycle top in oil after several weeks of what looked to be bullish price action was actually inside bar bearish price action, sucked in many retail traders, and now massive money is dumping into the retail crowd. So this wide range red bar is clearly your major resistance. If we get through there, we will look to add to our SCO position. Let's take a look at natural gas. Natural gas had a little bit of a pop this morning, gap up in the futures overnight yesterday. And one of the reasons why there was an explosion at one of the natural gas terminals and producers, ONEOK, I think is the company's name. So obviously that affects a little bit of the supply that comes on the market, which is hence the reason why natural gas popped. And I do think it's very fishy, and one can speculate that all of these headlines start appearing on an options expiration week. It's just very intriguing that all of these headlines start coming into the picture roughly in the same week, where it causes the price action of specific stocks to really start to, move in certain directions. And I do think that there were a lot of people this week putting puts on natural gas to come to this, $4.55, $5.50 area, or even $6, and now natural gas has popped up. If natural gas continues to float up a little bit, I will look to accumulate a short, basically around 680, or maybe I may wait for a pierce of $7. But I'm getting intrigued again for a natural gas short. Take a look at what the US 10-year yield has been doing. So the US 10-year yield, obviously we have our bond play. Let me just pull up the other one. So it is a down day for yields. You can see that we've had a nice little pullback here. Yields are down today around 2.59%. So the interesting thing that I'm watching out, are we going to create this topping formation where you have a left shoulder, a potential head? Now you want to see this rounding formation. You know, you potentially want to see yields float up a little bit more, maybe to the 3.15, and then start to roll over and make this rounding right shoulder. If we get that pattern, then we're on guard for a break in the neckline. But until we start seeing that right shoulder form, right now it's just kind of this choppy consolidation. It does favor technically a move to the upside still in yields, because you haven't really made a lower low. You look like you were falling and going to make a new lower low, but you managed to save it from taking out these lows. So you're still technically in an uptrend, but you really want to see yields now move up if you're bullish on yields to take out this high. But that might be a bit of a stretch. You may have to see a few weeks of consolidation before that price action occurs. But lots to consider. If yields start falling again and gold starts falling, I'm still waiting for that signal, potentially to move out of our long positions and really go defensive in the event that there could be some sort of liquidity crisis in the near term on the horizon. So we'll continue to monitor yields. We are long a few bond plays, so I have no qualms if yields start to fall. That being said, I do think yields should, for the health of the economy, should continue to rise, and until that inflation number really starts to decline. And yields are going to be interesting this week, because if that inflation number hasn't come down, then yields should continue to rally up. But if that inflation number does come down, then yields potentially could start falling lower. So this is kind of a very interesting week. It's actually a very interesting month. You do have not only the inflation numbers, the energy numbers, the PPI numbers. You also have the FOMC meeting at the end of the month. So there's going to be tons of volatility. Markets could be starting to shape up and start selling off ahead of that Fed meeting, but there's a couple scenarios that I'm thinking about. If we rally into the Fed meeting, I think the Fed jawbones us back down. If we have a massive sell-off from here on in this week, I think the Fed kind of keeps that trend and will help the markets, bounce, have a technical bounce if we sell off sharply before the FOMC meeting. So kind of lots to consider this week and this month, but I'm here with you. We'll be guided by the charts to see what type of price action occurs. So I'm just going to take a look to see if there's anything else. We did do a couple new positions today. Congratulations on covering our FFIE short, a beautiful 15%, just over 15%, so that's a tremendous winner to start the week. I love banking double-digit gains on a Monday to set the week on the right foot. And we also added to our Carvana. That's had a pretty sharp down day. We are shorting 3 new names. We're shorting ADP, NOC, and PWR. So those are been tremendous strong names as of late. But I do think since they're trading at their near all-time highs, eventually the bear market will come for all of these stocks. And I do think since the stocks that are trading at their near highs that haven't been decimated, I do think they will start to play catch up to the downside as these markets head lower. And certainly, there's shorting PWR. That's a direct energy play and power play. That's certainly going to help us in the event that the energy or the markets do have some sort of an epic credit crisis or crash. That will certainly play a massive decline in terms of where it's priced right now. Let's just pull up some of these charts just to see why we're shorting them. So again, if we look at like a stock like Quanta now, this is a very light volume stock, so it could potentially go higher, but I'm seeing based off of this pattern, there's a negative divergence with the RSI. If we flip to the weekly chart, you do have some nasty reversal candles that are in play, and I do think we've retraced enough to potentially start looking for this stock to come in sharply. And one of the reasons why is if you simply look at where the pre-COVID high is, which is right over here, before you had your COVID collapse. Look at where the stock is now trading. It's nearly up 300%. It's almost like those meme stocks like the Rokus and the Fubos and the SoFis and the SEs. That's pretty much what happened when we printed a whole gazillion dollars. These stocks ran up 2, 3, 4, 500%. And this stock is kind of acting like a meme stock. Now, that being said, it does have a viable business model and it does have hard assets, but in an economic decline with the one that I potentially see in the next 6 to 12 months, a stock like this is going to be shredded. I mean, simply looking at all of the previous collapses when you had your COVID crash over here, that was a mere, let's just do it from this candle over here. That was a beautiful 40% decline. If you go back later in the cycle, you had this little bit of a tightening cycle, this market chaos here. That was a 55% decline. Then you look at your 2008 housing crisis decline. That was an epic decline of 70%. You look at your dot-com bust. That was an epic decline as well. So this 97%. So this stock is certainly vulnerable, being the fact that it is trading near its all-time highs. And I just want to do something for my own visual. If I do that channel. So if you simply do a little bit of parallel channel analysis, if this cycle matches up to the dot-com bubbles, which I believe there are signs showing that many stocks are going through harsh declines similar to what the dot-coms face, you could expect a 2-year period that takes you all the way down to this $3-4 level. Now that would mean the economy is pretty detrimental. I'm not saying that's going to happen, and I probably wouldn't even be in the trade for that long, keep holding on to a short all the way down there. But I'm just saying it is in the probabilities that if we got some sort of a credit crisis, we could see a bigger decline than most people are anticipating. So another stock that we're in is NOC. Let's just take a look at NOC. NOC again is broken out of this range, but this is again is pretty much a war trade. And one of the reasons I'm shorting this is because it has very similar price action to oil. So this was your impulse move when the Ukraine-Russia invasion began, and you had a nasty reversal on this week, the first week of March. Everything that has happened for 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18 weeks has been trading inside of this bearish pattern. One would argue that, this isn't a bearish pattern because it's in an uptrend. Well, when you're trading near the all-time highs on an extended move, you're coming into long-term resistance. We have a 98 trend line over here that connects a pivot zone in 2018, which you're almost tagging. But the fact that you're trading inside of this wide range red bar for 18 weeks just means that institutions have been sucking in smaller retail money who don't understand the charts and don't understand the fundamental analysis of this company. And it means that a big move down is likely to happen in the short term because for 18 weeks you've had a ton of new buyers come in, but yet the stock hasn't been able to take out its previous high here. And it did have an attempt here, but it failed. So if anyone knows anything about a double top or a failed double top breakout, it's an extremely bearish pattern. And at the minimum, it should take you down to this gap fill around 408. But I do think we have a high probability of at least coming down to the bottom range of this channel or even at these lows over here. Now, it's not going to happen in a straight shot because this is a safer blue chip company and it has been showing strength. But I do think all of this inside bar trading from 18 weeks ago, the fact that we haven't made a new high, is just something that you should be concerned about if you're long the stock or if you haven't taken profits to protect your position. We're also shorting ADP. I'll just pull up the ADP chart. So ADP, one of the reasons why we're shorting ADP, again, it also has this price action, this divergent distribution happening. And if you notice, we've been stuck in this parallel channel now for a few weeks. You made your high here at the end of the year. You came up to test on this massive rally. And now I'm just going to flip to the daily chart. What is intriguing about this chart is this is your parallel this is your trend line that I've been watching for quite some time. It connects your COVID low to a major pivot over here in February. and you've retraced. You managed to close above that line, but you've never confirmed back above that trend line. So this trend line is major resistance. So you had this impulse move here on a bullish pattern. You would have looked for confirmation, but this failed to confirm. You sold back down. You were saved. You gapped up again, and now it looks to be you failed again, failed again, failed again. So not only on 1, 2, so there's 2 occasions here where you failed to confirm above this massive trend line of support, which is now a massive trend line of resistance. So the fact that you're failing to recapture this trend line is enough for me. We're at the near top of this channel. You are starting to see distribution price action. Buy volume is starting to decline to the downside. So there's many different factors, and the fact that this PE is still trading astronomically high. I mean, simply when you think about, where this stock was trading before the money printing occurred, all the way over here, 172 is the fair market value in my opinion, where this stock should head over time as the indices head and the economy deteriorates. So we'll continue to monitor this. I do think it's lovely to be positioned on the short side. I mean, there are tons of people that have been really getting smoked today on the decline, in various names. But the fact that we're net short the market is just tremendous. Once again, our account is growing, and considering now we're just closing the day out, the Spiders basically closing the day with volume of 46 million. So extremely, extremely light volume. And today the Chinese ADRs were hit pretty hard. So things like BABA, we were up nicely. We're still in the money pretty deep, but obviously seeing an 8 to 9% decline isn't the best thing to wake up to. But nonetheless, with the zero COVID policy in China, a lot of the companies are now having to shift because there's potentially lockdowns in Macau and various places like that. You did see the casinos getting hit tremendously hard today. But overall, those are short-term price action indicators that, it will resolve. I do think that the media blows these things out of proportion when you look at in relativity to the size of China and the amount of people that are being locked down. It's very, very small. So let's just see how things shape up. But well done on our profits today. It's great to be net short. I do think eventually we will see a sharp down leg in the markets, but I don't think that's yet. I do think that we have too much pessimism in the markets, which I think we still have to see a rally to slowly change people's sentiment to more of the bullish side before we get that downturn. That's just me speculating and reading the charts. Nonetheless, please give this video a big like down below, and we'll stay tuned for more price